That's why understanding crypto regulations is crucial for every investor. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. Crypto regulation matters because it sets the rules of the game. For investors, it determines whether they can safely invest, avoid fraud, and know how much they owe in taxes. Compliance ensures legitimacy, while anti-fraud measures protect markets from scams like Ponzi schemes or rug pulls. Let's dive into the regulatory landscape of four major players: the US, Canada, Australia, and the UK. Starting with the United States, we see a fragmented approach with multiple agencies involved. The Securities and Exchange Commission, SEC, views many tokens as securities, while the Commodity Futures Trading Commission, CFTC, treats others as commodities. The Internal Revenue Service, IRS, requires detailed tax reporting, including capital gains, and even reporting of crypto held on foreign exchanges. Meanwhile, the Financial Crimes Enforcement Network, FinCEN, enforces anti-money laundering compliance for exchanges. Legal battles, such as the Ripple XRP case, highlight uncertainty. Courts are still deciding which tokens qualify as securities, potentially setting precedents for how cryptocurrencies are classified and regulated. Moving north to Canada, we find a more coordinated approach through the Canadian Securities Administrators, CSA, and Financial Transactions and Reports Analysis Centre of Canada, FinTrack. Exchanges must register, which builds transparency. Taxation in Canada is strict. Profits may be taxed either as business income or capital gains, depending on the nature of trading activity. This can affect small investors versus professional traders differently. While Canada's system provides clarity, it also raises compliance costs for platforms and users. Crypto is regulated through the Australian Transaction Reports and Analysis Centre AUSTRAC for Anti-Money Laundering, and the Australian Securities and Investments Commission, ASIC, for Securities and Consumer Protection. Exchanges need licenses, which promotes accountability and trust. Australia strongly emphasizes consumer protection, ensuring retail investors understand risks before participating, which means investors must carefully track transactions. This encourages long-term holding, but complicates frequent trading. The Australian approach balances innovation with safeguards aiming to create a stable environment for crypto growth. Across the pond in the United Kingdom, the Financial Conduct Authority, FCA, is the key regulator, and it has taken an aggressive stance. Exchanges and custodial wallets must register with the FCA and comply with AML requirements. The UK's approach balances innovation with caution, focusing on protecting retail investors from scams and risky products. Across the board, there are strong AML KYC requirements and taxation of crypto gains. Every government wants to prevent crime and collect tax revenue. But the differences are where it gets interesting. Australia puts a spotlight on taxation and consumer protection, while Canada requires strict registration for exchanges, making compliance non-negotiable, sometimes conflicting sets of rules. Now, let's talk about the risks and opportunities these regulations create. The main risk is uncertainty. It's a minefield that requires constant vigilance and adaptation. But it's not all doom and gloom. Regulations, when clear, create trust. Investor protection attracts larger institutions like banks and funds who need legal certainty. This can stabilize the market and reduce fraud. Without cooperation, companies face conflicting rules that hinder innovation and growth. Many governments are exploring central bank digital currencies, CBDCs, which may influence crypto's role in the financial system. who require clear regulations. It's a trade-off between explosive growth potential and long-term sustainability. In conclusion, across the US, Canada, Australia, and UK, regulation is tightening, but with different priorities. Securities in the US, registration in Canada, consumer protection in Australia, and derivative bans in the UK. For investors, the golden rule is stay compliant, keep meticulous records, and adapt quickly to new legal changes. Understanding these regulations is just about avoiding trouble. It's about positioning yourself to take advantage of opportunities as the crypto landscape evolves. Whether you're a seasoned trader or just getting started, staying informed about regulatory changes is crucial for your crypto journey. We want to hear from you. What's your take on crypto regulations? How do they affect your investment strategy? Share your country's perspective in the comments below. And if you found this information valuable, hit that subscribe button for ongoing insights into crypto laws and trends. Remember, in the world of crypto, knowledge isn't just power, it's profit. Stay savvy, stay compliant, and we'll see you in the next video.